So the two biggest misconceptions around reverse mortgages are these. The bank is going to take my house and there won't be anything left for the kids. So let's cover this one first. There is what they call a lien on title, which means when you leave the home and sell it, or you pass away, the home will be sold and whatever the balance of the loan is will get paid off and whatever's left will go to your heirs. It is no different than if you have a regular mortgage. In fact, there's actually a really neat advantage. If you have a regular mortgage and you pass away, the kids have to make the house payment until the place is sold. And so if that's through the holidays or through the winter, that can be a burden. With a reverse mortgage, if you were to pass away, you have 1 year to sell the home, and there is no house payment during that year. Now let's talk about the issue of the kids will have nothing to inherit. What I found is this illustration really provides clarity and people seem to love it, so I'd like to share it with you. I want you to think of your house like a bucket. And so here's the bucket. And this bucket represents your house. And so from here to here, that's the value of your house. That's how much it's worth. So let's say, just to make this easy, your house is worth $600,000. Okay? So let's say you had an existing mortgage of $200,000. And we did a reverse mortgage, we eliminated that $200,000 mortgage, and so now you have no house payment. You still have to pay the property taxes and the insurance, you still have to keep the house up, but that regular mortgage payment, let's say it was $1,500 a month, it's gone. And so that's like a $1,500 raise. So let's put a $200,000 mortgage on this house. And so we'll call this water in the bucket. That's the amount of the loan. There's a $200,000 loan. Now with the reverse mortgage, you don't make a house payment. And so how does that work? How do you not make a house payment? Well, every month, the payment you would have made gets added to the bucket. So think of a little cup here. And so every month, the payment you would have made gets added into the bucket. So think about a little bit of water getting poured in there. And so now you're connecting the dots and you're like, oh, wait a minute. That means at the end of the month, the water level's higher. And at the end of a year, it's higher. And so that water goes up. And so you're probably saying, oh, I knew it, there goes the kid's inheritance. And what you're thinking is, at some point, the water might overflow. Now here's another great feature of a reverse mortgage. If the water ever overflows, and then you pass away, let's say you owe this much on the house. Your heirs, your estate is not responsible for the difference. So let's say by some fluke you owe $800,000 and the house goes down in value to $400,000. You are not responsible for that other $400,000. That's what the FHA mortgage insurance covers. But here's the piece everybody misses. Yes, the water goes up in time, but in California in particular, if you look at a 70-year average, real estate tends to appreciate over the long haul at a rate of about 4.6% per year. Some years, like the last few, homes go up in value much quicker. Some years they don't go up, they go down a little. But over the long run, let's use 4.6. And so what really is happening is this. The water's coming up, but the value of the house is going up. And so we may get to a point where, let's say 10 years from now, you move out and the water's up to here. And let's say that the water's now at 300,000. But the house appreciated over 10 years, and let's say the house is now worth 800,000. And I'm just using easy numbers so I can do the math. And so what we saw here is the house was worth 600, and when you started you owed 2. So you had 400,000 equity. And now you owe $300,000, but the house is worth $800,000. And so this piece is $500,000. And so what most people get at this point is, oh, so you're telling me that I don't need to die soon for the kids not to lose their inheritance. And of course, no, you don't have to. And most people are pleasantly surprised to find that in fact, the longer you stay alive, the more the kids will inherit. One last point. Yes, if you didn't put any loan on there, the kids would inherit more. But here's the bottom line. You need to spend whatever it costs to live. So whether the money comes out of your right pocket, your checking account, or your left pocket, you're going to spend the same amount either way. But this way, what you have is better cash flow, more income, and so you're in a much more comfortable place along the way. And either way, no matter how much mortgage is on your house, the house is going to continue to appreciate, which is what makes this such an interesting and oftentimes valuable financial instrument. Thank you.